This trading system beat the stock market for more than 30 years without losing a single year. It's even more powerful than Warren Buffett's value investing, especially if you do not like to lose money. So I'll be sharing with you how Edward Thorp beat the market using options arbitrage. Hey tribe, in this video I'll be talking about Edward Thorp. He is the first guy who used quantitative trading and he has trashed the market for more than 30 years without losing a single year. So in this video, I'll share with you how he uses options to create option arbitrage opportunities where he doesn't lose money because there's a price difference between the options and the stocks and he takes advantage of it. So Edward Thorp, he wrote this book called A Man for All Markets, but besides being a best-selling author, he's in fact someone who won the market for years. If you look at his hedge fund called Princeton Newport Partners, if you invested in his funds in 1968, he has gone all the way 14 times up. The amazing thing is, if you look at the curve, it is a very smooth curve without losing a single year. Let me just bring your attention to especially 1973 and 1974 right here. You can see that the curve is smooth. Now, why do I zoom into that period? Because even the super investors that Warren Buffett talked about, like Sequoia Fund, you can see in 1973 and 1974, because the stock market went down almost 30% within that 2 years. If you look at it, even the great Charlie Munger lost huge amount of portfolio losses within that 2 years. And if you track back for Berkshire Hathaway, Warren Buffett, he himself also lost a great amount of wealth on paper loss in 1973 and 1974. But if you look at Princeton Newport Partners, in 1973 and 74, their average returns was 17%, while Charlie Munger, Warren Buffett, Sequoia, Walter Slosh, all the other super investors lost more than 10 to even 20% for both of the years. So how could that be done? The trick is here. Edward Thorp's first hedge fund was called Convertible Hedge Associates. The good news for both you and me is Edward Thorp's background was an MIT lecturer and he has the heart for teaching his methods. To him, investing is more like a game than making money. Instead of publishing papers in the academic world, he found a lot of joy by immediately writing his methods into books and sharing with people. Unfortunately, his book called Beat the Market isn't something that you can find on Amazon right now because it's so difficult to read, many people give up reading it. So after spending weeks of really diving into his books, let me explain to you how his method works and how we can use it as well. If you look at his book called Beat the Market, there are many of such graphs. What he was trying to look for is when options are being mispriced. And by taking advantage of it, he entered into what he called a no-risk trade. In simple terms, whenever options are overpriced, he will sell the options and buy the stocks. And if options are underpriced, he will buy the options and sell the stocks. This is something called pair tradings and is extremely useful when he sees a very distinct arbitrage opportunity. Arbitrage opportunity means that options pricing is being mispriced and there's an obvious undervalue or overvalue. And given time, the price will go back to its fair value. And options, unlike stocks, have a certain lifespan. They will return to their original value very quickly. More than 30 years ago, Edward Thorp was one of the first few people who had access to what we call a computer, which all of us have right now. So using the IBM computer he had in MIT, he did multiple simulations and the conclusion is the same. He will be able to profit with very little or almost no risk. So the question is, how can we also benefit from this? After doing tons of research and trying to find undervalue or overvalue options, I found a particular website that gives us the chance of finding such options. By the way, this is not a paid or sponsored video, but this particular website called Bar Chart is amazing. I'm using Bar Chart to hunt for undervalued options and other kind of screeners. Now in Bar Chart, you can see I have not logged in because I'm using the free feature. You can click on Options tab and click on Options Calculator. And while I use the premium function, you can use the free function. So in the Options Calculator, you will see example for Apple, you can look for the call or put option, the expiration month, and also the strike price. Now here, there's a calculated theoretical value. So this theoretical value is based on options pricing model such as the Black-Scholes model, which by the way, Edward Thorp has already created a particular model even before options pricing was known to the world. And this theoretical value matches pretty closely to how he calculated options pricing. You can see right here the theoretical value of Apple call options with a strike price of 225 with this expiration date of 24 days to expiry. It's $6.26. The current price of the Apple options is $6.29. There's only a 3 cents difference, so there isn't a huge chance for us to do arbitrage. But the purpose of showing you this screen is to show you when we look at the difference between the theoretical price and the market option price, there is an opportunity. Now, based on Edward Thorp, one of the best ways to find mispriced options is during dividends. Why is that so? Let me give you an example. So let's look at the dividend calendar, and you can see right here a couple of stocks are giving out dividends today. So a stock that is familiar to me is called Dell Technologies, and they are giving out 0.445 cents of dividends. This will cause a change in both the stock price and the options price. Let me explain. When we buy, example, a call options of Dell, we have the rights to buy 100 of Dell stocks at an agreed price. So this particular premium that is priced into the options take into account how much Dell is worth. So there's a premium we must pay for the call option in order to purchase 100 Dell stocks at that strike price. Now, when Dell's stock price changes, so does the premium of the call option. However, when Dell announces dividends, that's where mispricing of the options premium may appear. Here's the theory. Imagine initially you have the rights to purchase 100 Dell stocks. And now this 100 stocks has declared dividends. Now when they declare dividends, what it means is they are giving you cash. In some cases, some of the stocks, when they announce dividends, they are giving you partial cash and some stocks as well. Whenever they give you cash or stocks, think about it this way. You can even take some of the cash to buy even more stocks. So these 100 stocks, imagine if they give you 10% of dividends, you can take the money and buy 10% more stocks. So this 100 stocks is in fact now increased to 110 stocks. So with this particular assumption, the call option initially that was controlling 100 stocks, it is now worth 110 stocks. So while in the stock world, we can see whenever a stock announces dividends and they issue dividends on a day, the stock price will increase by the amount of dividends that it is issuing out. The options may not move exactly the same way because the calculation is a little bit more complicated and there is a time delay. And therefore, this is the chance for us to take advantage of what we call an options arbitrage. Now let me show you Dell's theoretical value for their options versus their market price. So right here, I have Dell Technologies call options at 129. The theoretical value is 5.89 because they are issuing out dividends today. And you can see the market price is 4.9. That's a $1 difference. So in this particular case, there is an opportunity to do what we call an options arbitrage. We can purchase the options because it's undervalued and we can short the stocks. And given time, there will be this particular phenomenon called regression to the mean, where both of them converge back to the fair value, and that's how we make a profit. I do highly recommend you read the book called Beat the Market by Edward Thorp. It is a phenomenal book. It's 229 pages of pure insights, and he goes through in depth into examples which is relevant even up to today. In fact, right now, today, we have computers with us. Even your handphone is a computer. There's a kind of advantage you had 30 years ago, which we should leverage on. If you've got questions or you want more examples, do comment below. And if you like videos like this, do subscribe to us, turn on the notification button, and give us a like. Follow our channel to learn more about investing and options so that we gain an advantage in the stock market. I'll see you in the next video.